Hello YouTube, this is Nams. So in today's video we'll be looking at the topic of liquidity and so on. So let's get started. So I'll be using crude oil known as US oil for this lesson. So let me do this. Let's say this is our board. Let's say it's white, and then bring it here, and then we'll give it white as well. Okay, so I bring this here again. So if you have been finding these lessons to be helpful, make sure you hit the subscribe button so that you don't get to miss what we are doing on this channel. Our aim is to help traders to achieve their dreams, learning how to trade for themselves and make money for themselves. Okay, so let's get started. So what is liquidity in trading? Okay, let me use which one will I use? Okay, I'll just use this two. It's more. Let me just look for something which I can use just for pointing. Okay, I'll use the arrow, and then I'll just put it on favorite. Okay. Increase to 4, actually to 3. Yeah. Okay, let's get started. So I'm simply saying to say liquidity means areas where many stop losses and orders are placed. Big institutions and banks need liquidity to enter large trades, so they often push price to these areas first before the real move. In simple words, liquidity equal where traders place stop losses. In other words, liquidity is money. So we have types of liquidity. Number one, we have buy-side liquidity. This is above highs in the market, where it forms equal highs, previous highs above resistance or below the support. Why it matters? Many traders place buy stops or stop losses for sell traders there. So price often move up to take that liquidity first, then drops. We have another one. We have sell side liquidity. This is below lows in the market. Where is it from? Below equal lows, below previous lows, below support. So above the resistance, what you find among the types of liquidity, above the resistance you find buy stop. Buy side liquidity. Above the resistance we have buy side liquidity. Below the support we have sell side liquidity. This is what it means, SSAO. Okay, why it matters? Many traders put sell stops or stop losses for buy trades there. Okay, let's keep moving. And then price often drop to grab liquidity first, then moves up. we have also something which is called liquidity sweep. What is liquidity sweep? Liquidity sweep happen when price goes above highs or below lows, then reverse quickly. So this means whereby it will just come, hit your stop loss, and then it moves to the direction you predicted. That's what we call, or that's what it is known as liquidity sweep. Others, they call it stop hand. So then price reverse quickly. This is also called stop hand. Institutions use this to collect orders. So if you don't know the concepts of liquidity, I believe this is the best video for you. Let's keep moving. Common liquidity areas. Look for liquidity around equal highs, equal lows, previous day highs or lows, support and resistance. We have also trendline liquidity, simple liquidity trading idea. Example with gold. 1. Price forms equal highs. 2. Price sweeps them. 3. Market reverse down. Look for sell entries. Beginner tip: do not enter immediately when liquidity is taken. What do? Wait for number 1, break of structure, order block, and then confirmation, and then you can enter. So now let us start with what we have just written here. Okay, so we'll start with buy side liquidity. So buy side liquidity, that I'm simply saying to say this type of liquidity is found on equal highs or lows. So what it means? It means this: assuming that price is moving up, it comes down, for instance, to create a low, and then instead of taking out this high, maybe price do this, creates another high instead of taking the previous high, but it goes and creates the high maybe on the same level, and then it drops, and then maybe it is doing something like this. Let's assume to say we are in an uptrend, or actually let's say assume to say we are in a bearish market. So what price would do? Price definitely will come to sweep this equal highs, maybe tap into something like an order block. It can be a resistance, tap there, and then it drops. That's what it means, equal highs, whereby on these highs we have liquidity which is resting on them. Yeah, like I said, for instance, we are coming from upside. Yeah, this is a form of liquidity which is normally found in the market, which is equal highs. Okay, so let me just remove them. And then we also have previous highs, or this is a type of liquidity. You find them on the daily candle high or low. So what do you do? For instance, this is the daily candle. This is the daily candle. We're going to give it, let's say, red. Yeah, we're going to give it red. Let me remove this. So assuming this is the daily candle. Okay, this is the daily candle. I put it in white. Okay, so what do you do? For instance, if you want to start trading, what you do is that you mark the high and you also mark the low. Why? Because it is believed to say, for instance, price starts by taking the high first. In most cases, there is a probability or possibility of coming to take the low. What it will do, it take the low, retest the same low it has taken, and then it continues to drop. So this is also a type of liquidity which you need to be aware. And then we also have above the resistance. So above the resistance is just like the same as the first one which I've just explained. Let's assume to say we have a resistance in here, and then we have a support in here. We have a support in here, and this type of liquidity most of the time, see, it happens if maybe we are having maybe news. We have news which is coming. Let me just shift the time frame. Okay, let me just go back. Okay, like we are having news. So what price would do something like this. It will consolidate. Maybe the whole let's assume say this Friday we have NFP. So what price will do will just be in a ranging form. It hit the resistance, it drops, it hits the support, just like that. So what it means to say above the resistance, above this resistance, people will put their stop losses here, wanting to short the market. So what the market will do, maybe during NFP or CPI, it will just come and just wick above the resistance, taking out the stop losses of people, and then it drops. This is what it means. This is what it means. Or you can see something like this. It will do this. Something like this. And then it comes up, and then again it continues. Something like this. What does this tells you? It tells you to say maybe below the support there are stop losses. So what the market will do, this is what the ICT traders call the AMD. So during this process, the market is engineering liquidity, or it is liquidity is getting formed. So what the market will do is that this is an accumulation phase. So what the market will do is either it will wick one side and then it drops, or it will wick to the for instance, it will take out the stop losses of people who are wanting to buy the market. It will just wick them out with a wick, whereby it will just come maybe heavily and then take them out. And then after taking them out, it will not close below this level. And then what you see a pullback. So what it is that in this accumulation, the market was generating liquidity. So after they have generated liquidity long enough, so what the market will do is that it will take out the stop loss of the early buyers. People who bought somewhere here, putting their stop losses below the support. It will just come and wick them out, and then from there the market continues to push up. So this is something which you and I will need to be aware of. Let me remove this one, and then same what I have just explained on the buy side, that's how it is on the sell side. What they will just maybe create something like a resistance, whereby the market will consolidate, accumulating, and then once it has accumulated long enough, what they will do is that since we have sell side liquidity, so what they'll do, maybe the price will just do this, wicks them out, and then flies. This is something which is common in the market. And then there is this type of liquidity which happens. For example, you have an order block in here, you have an OB, an order block here, and then what we expect something like this. Let's assuming to say price was in an uptrend, and then it left behind an order block. So it is in an uptrend. So what price, sorry, let me remove it. So what price would do this? Assuming to say we had an accumulation here, price was accumulating, and all of a sudden we have an aggressive move, and then that aggressive move leaves an order block behind. So what price would do something like this. just to create a trap, and then broke structure. And then after breaking structure, this is what will happen. Let's assume to say you have an order block here, and then let's assume to say this thing is not there. Yeah, so people, what they have been told is that choose the order block which has broken structure. Choose the order block which has caused the break of structure. Let's assume to say this order block is the one that caused the break of structure. So what you see is that maybe price will come down. Maybe it will be doing something like this, and all of a sudden it takes you out after hitting your stop loss, and then it continues back. So most of the time this thing happen, especially if you don't know how to validate an order block, or you don't know how to pick a correct order block. So we have what we call internal, although I did not write them here. There is what we call internal and external. So assuming to say this is our starting point, this is our origin, and price, let's assume to say it consolidates a bit. It consolidates, and then we have an aggressive move. So when we have an aggressive move in this price leg, what is remaining here is either you have an imbalance or you have an FVG. So those point of interest you have is either they can be used as internal liquidity, and then the external liquidity, it is the one which is you find it on external points, assuming to say you have a swing point, or you have a swing high or you have a swing low. That's where you find external liquidity. But in this case, your order block was supposed to hold price, but instead you were liquidated, something like this. Just price came and then liquidates you. So in other words to say, this order block was used to trap people or to trap traders. Maybe it will weak you out, tapped in the correct PUI, and then it start flying up. These are the things which you need to be aware of. And then let's see what I have for you here. We are saying institutions use this to collect orders, common liquidity areas. Look for liquidity around the equal highs, equal lows, previous day high, support and resistance, and then we also have trend line. So trend line liquidity, this is what it looks like. Assuming we are in an uptrend, we have an origin, we have a break, we have a retest. It came to create a low, and then assuming so we break structure again, and then we have a retest, and then we have a break here. So trend line traders, what they believe is something like this. They expect something like this. So yeah, something like this. So what they expect is that price needs to come to retest the trend line, and then it goes up. So this trend line can be used as liquidity as well to trap the traders who use trend lines. Why? Because of this trend line is either it can break, and what trend line traders believes is that once price breaks the trend line, what they expect a retest of the trend line, and then they sell it off. So this is also the type of liquidity which is common in the market, of which I want you to be aware of. So now this is what is happening. Let's assume to say we have it like this, and then we have a trend line here. We have a trend line here, and then we have a trend line here. Just like I've explained, they expect a bounce from the trend line, and then it continues flying. So that's the type of liquidity. And then we also have breakout traders. What is it that they have been told? If price breaks structure again, it breaks structure again. So what they have been told is that once price retests, for instance, price comes down, in these areas they will use maybe a bullish engulfing candle to enter into the market. For instance, they have a bullish engulfing candle. Where is it short long? So what they will do something like this, putting their stop losses below this low. And then apart from the break and retest traders, we also have S&R liquidity support and resistance. What is it that they have been told? They have been told to say, if price breaks this the resistance, once the resistance is broken, it becomes a support. So what they have been told is that if once price breaks and then it retests, so what they will do something like this. They will put their buy stops here or buy limit on this same level, maybe targeting this high, maybe a stop somewhere like this, hiding behind this resistance. So what they are doing is that on this level of resistance, they are creating a lot of liquidity to the downside, of which the institution will come and use to sweep them out. So if you are a smart money trader and then you are putting, for instance, you are buying from here, you are not different from the little traders. So what do? It's very important to understand, to say for your order block to hold, there have to be liquidity above it or below it. So let's jump in and just let me give you an example before I make this video to take long. So okay, where is it? Let me look for an example. Okay, network. Oh, okay. Let's try to see some examples where the order block failed. Example, this one. Let me just start. Okay, somewhere like this. Here we have a break of structure, and the break of structure we have left behind this order block. Left behind this order block, we have our liquidity here, but let's see what price did. No. Okay, let's see what happened. Let's see. Okay, let's get this sale. Where did this sale started from? As you can see, we are in a downtrend, and number one, we have this high, and price broke the low here. We have a break, and we have this order block. Have you seen what happened? Price just came, took out this order block, and then it dropped, because people have been told to say choose the order block which broke structure. But if you notice the real move, the real order block was here, this bullish candle. That's where the real thing was. People who tried to sort here, they sold, and then price went back, liquidated them, or they were taken out, and see what price did. After tapping into the correct order block, price continued dropping. It dropped. If you check, it dropped. So if you bought here, you sold here. If you sold here, your stop loss could have been here. But those who thought of maybe selling from this order block, see what happened to them. Here, they sold just a bit, and I believe they were targeting this low or this low. But what did price? After tapping into this order block here, at first it gave some reaction, went back again, tapped into it, gave some reaction, and then finally it took it out, tapped into the correct order block, and then price fell down or dropped. Okay, so if you have found this video to be helpful, make sure you subscribe to this channel, turn on the notification bell, just to help this channel to grow. See you in my next video.